take a look at S&P against bond prices, just quickly before we get into the cash over. We've got 4 minutes. So take a look at this this chart here. Now, what this chart is S&P and bond prices together, right? So this is S&P and bonds. When the S&P is cheap to bonds, it represents a reasonable opportunity because there's a lot of hedging in the markets. And you can see that during this period here, you can see the S&P was very, very cheap to bonds, wasn't it? The S&P was actually cheap to bonds here. And therefore, there is a fair amount of hedging, and it tells us the S&P as a global balanced product is cheap, so we can buy into equities here. The big rally in equities was good, and but take a look at what happened here, guys. The S&P became very expensive against bonds. The S&P became very expensive against bonds. Now, obviously, what that means is that people have to perhaps start buying bonds. People have to perhaps start buying bonds, which might give us a bit of a hedge. But obviously, we don't see that happening. So this puts the S&P into a real risky environment just now in this area. And obviously, that results in what ultimately was the sell-off from April 2022, as we got that big sell-off. When the money went too heavy into equities, the balanced market funds are now on the wrong side of that drop. Yes, the balanced market funds are on the wrong side of the drop. Does everybody understand that? Well, if the balanced funds are on the wrong side of the drop, you can see that that sell-off went from 4,500 to 3,800. It was a 700-point sell-off, which is pretty good, right? Now, what happens next? The balanced funds get ahead of the market here, and it causes the market to just jam into the bottom edges. And that creates the conditions for a rally phase coming off that price. Now, take a look at what happened on this rally phase. Do you see it? Do you see the problem starting to brew? You see it right there? It looks almost the same as the problem that brewed right here, doesn't it? You see the same problem? You see the same problem there? It's almost the same problem that was brewing. They got too committed into long equities, into long stocks. And obviously from that too committed narrative has been this current sell-off that we've just seen right there. So when I see them getting too committed like this into these types of narratives, you've got to remember that, well, how the hell do they get the trade narrative moving? How the hell do we get the trade moving on this? Well, what is this as a pairs trade? Well, the only thing that this is a pairs trade, Simon, is selling equities. This is all this is, isn't it? Selling equities. When the blue line gets higher than price, you sell equities. When the blue line gets lower than price, which happened obviously over here, when the blue line gets lower than price there, you buy equities, and that's why we saw that recovery being staged from those two low prices there. But what's the chances the blue line's going to be able to get below equities here? Pretty slim to none, right? Pretty slim to none. So the balanced funds have a real money problem. They are still overcommitted to long equities. Why are they overcommitted to long equities? Because they didn't want to own bonds. They didn't want to own bonds because they know that inflation is going to wipe out the value of bonds. So they overbalanced on long equities until they fix that imbalance. There's a bit of a problem, isn't there? Does that make sense to everybody, guys? Yeah? It is relatively straightforward in terms of balanced funds, and this is what we did in Classroom a long time ago. Remember when we tried to get you guys to start understanding the idea of balanced funds. And you know, when we get into the idea of trying to understand the rotation of money from equities into bonds and back into equities, or percentages in equities and bonds, remember a balanced fund is predominantly a 60-40 fund, 60% equities, 40% bonds, but they have a mandate to run 60-40 on the other side at times as well. But when they are heavily committed to long equities, then they've got problems. they have to rebalance, and the only way the way they rebalance is to sell equities, and that obviously causes the equity problems that we've just seen at those higher prints. So it is something that you should be obviously watching and paying attention to when it happens. Bonds back into the lows. I am back on bid watch on bonds again, guys. Back on bid watch again. Last two rotations I've been busy with. We've made some nice money on each of these rotations. The last one we bought at 5s, took it up to 24s for a very nice $600 profit. But we are back on bid watch again. Coming into the cash market open. Let's see what they do with this cash, guys. Let's see what they do with this cash. I have resold bonds, by the way, guys. 75s this time, 75s sell side. We got a big spike in volumes. We got a big spike in volumes as we moved a measure to the upside at 75. So I have gone short SF, short oil. It's a good looking location to go short oil because it was almost exactly the measured move against the previous bracket. So you'd already know about the 75.80 price level. Yes, oil traders? Don't dare say no. So here's the storyline. You can see obviously we had this bracket high here. We sold this a couple of times down into this big volume reversal here. That was the walkaway trade that we talked about in Classroom a short while ago. We said we're walking away from the trade into this profit take at 60s. You can see obviously when we broke this to the upside, we obviously have a measured move which takes us to 75 for the sell trade. Takes us to 75 for the sell trade, and obviously from that 75 sell, you can obviously see that the little drift off we're getting reasonable so far. $200 a contract. Let's see if it's got any more for us. But I like lower price bonds at the moment. I like that 149 price. I kind of did not expect to trade 149, but you know what? The lower she goes, the more we get, the more value we get for any trades. The more extreme the price, the more extreme the profits. We're liking it. We're liking it, guys. We're liking it. We're liking it. We're liking it. Paul, the twos. No, the inversion was just after 9 o'clock. But the other thing was that we then got a tens inversion over the 30s inversion on the tens 30s. So what Paul's talking about was we actually did get an inverted twos tens curve this morning, and an inverted twos tens curve is something we haven't seen since 2019. But it wasn't just the twos tens curve that was inverted. It was the tens 30s curve that was inverted. Tens 30s curve that was inverted as well. So here's the curves here. This is on a daily chart. The blue line is the tens 30s and the orange line is the twos tens. And the scaling, well, let's take away the blue line just now. So the orange line, this is the inversion right. There's the inversion on the orange line. And obviously, you might say, but it's not inverted. You're right, it's not inverted on this current chart, but let's take a look at the 10s, 30s. The 10s, 30s also inverted. The 10s, 30s inversion, is it inverted? It's right on the inversion, yeah, it's right at zero, literally at zero. Let's take it from the dailies down into the 15-minute charts, and you'll see the inversion this morning. Okay, so first line first. There's the 2s, 10s at zero, yes? I can now just make that a little bit more accurate. There it is, right at zero right there. So there's the 2s, 10s at zero, which is a great place to obviously do business on bonds, generally as a rule. And let's take a look at the 10s, 30s. Now remember, the 10s, 30s is at zero at this point here. Okay, so the 10s, 30s is at zero at that point. You can see that we got within literally a whisker of that inversion again on the 10s, 30s as well. So obviously when we get inverted curves, generally as a rule, it brings a lot of business into the bond market. Okay, a lot of business comes into the bond market, and that's something that we're obviously watching, and that's something we're always aware of. Is inversions generally as a rule gives us something to play with. Now, if you trade bonds and you didn't know that, you shouldn't be trading bonds. Of course, that should be obviously it goes without saying that if you didn't know about inversions and stuff like that, you shouldn't be in the bond market, because this is obviously big stuff for bond traders. Let's see what it does to bond prices. Let's see what it actually does to bond prices. So we'll overlay this with a bond price itself. Now, this is why a lot of people look at it and go, wow, this makes life very, very awkward, because what are we normally doing? Well, if we think that the 2s, 10s is going to steepen because it's just inverted, the normal response to bonds at that stage would be to be selling bonds, wouldn't it? You understand that? The normal response would be to sell bonds. Well, that's the sell we got on bonds on the black line. So if you didn't know about that inversion there, you wouldn't have known that the bond had further to go to the downside. So it should be something you must know about. It's as simple as that. Then when the inversion on the 2s, the 10s, 30s comes out to play, you say to yourself, wow, the 10s, 30s is just inverted as well, pretty much. If the 10s, 30s is going to steepen, is that going to start putting in a sell in bonds as well? Because obviously for the 10s, 30s to steepen, you need to sell the back end of the curve, and that puts another leg of selling into bonds as well. And that's exactly what happened. We got another leg of selling on treasuries. Now, when we look at this, we can start to recognize the relationship at times of these elements. The 10s, 30s is the growth side of the curve, isn't it? So when we saw that the 2s, 10s had went too far, and this is why we start understanding things like bonds here. When the 2s, 10s goes too far and it causes this opposite effect on the 10s, 30s, the 2s, 10s can't really go any further. So what do we do as a rule? We sell 2s, 10s. You understand? We sell 2s, 10s. And if we sell 2s, 10s as a rule, what do we do in bonds? Generally, as a rule, we buy bonds during these periods. We try and buy into treasuries during these periods. And obviously, buying treasuries there made a nice pop there, and we made a nice pop there. 2 days, 2 profits, 2 easy narratives. So obviously, it's always about learning this understanding of the relationship of the 2s, 10s, and the 10s, 30s to see how we can start recognizing what's going on. Makes a lot of sense? Makes a lot of sense, guys.